You. We are now arrived at our final and most awaited segment of the day, a power packed discussion titled The Investor's Dilemma: Betting Big on AI or Waiting Out the Hype. As artificial intelligence continues to disrupt industries and redefine innovation, investors are facing a crucial question. Is now the time to go all in, or is patience the smarter play?
To lead this highly anticipated session, we are privileged to have with us Mr. Ramesh Gupta, Head and Director of Risk Practice of FIS Global Solutions. Mr. Gupta is an accomplished leader with extensive experience in digital banking, fintech, and AI-powered risk analysis.
Please join us in welcoming our moderator, Mr. Ramesh Gupta. Joining him on the panel is Mr. Manish D'Souza, Chief Investment Officer at Outnorm Ventures and Outnorm Capital. Mr. D'Souza is a visionary investor and startup mentor who has played a key role in shaping India's AI and deep tech investment ecosystem. Please welcome Mr. Manish D'Souza.
Our next distinguished panelist is CA Abhijit Preman, founder and designated partner at Abhijit Preman & Co. LLP, Bengaluru, and partnered at Syndicate Advisor, Dubai. Let's extend a warm welcome to CA Abhijit Preman.
With that, let's invite our moderators and panelists to the stage of an engaging, insightful conversation on the realities, risks, and rewards of investing in AI.
Thank you very much. Good evening, everyone. Is the energy level still there? Hope it is. Now we are going to have the session, The Investor's Dilemma. We are at the good cross intersection of whether AI is a hype or AI is something that is giving real value to the investors, to the customers. If you see the trends, there are people who are talking about 95% of the AI projects are becoming failure. There are people who are also talking that this is like a big AI movement. If we miss this opportunity, we will miss building another Google. If you look at the investments are growing rapidly. This year, the investment size is $138 billion, and 52% of the venture capital investment is coming from AI. And on the other side, the number of deals are coming down. Earlier it was, in 2016, if you see, it was around 30,000 deals, and it went to 50,000 overall startup deals, and now it has come down to 30,000 deals. So we see a trend of higher investment and then lower number of deals. With this, we have two extreme panelists, two extremely renowned panelists, Mr. Manish and Mr. Abhijit. So both are uniquely placed to address this panel discussion. Manish is talking to investors, talking to startups on day-to-day basis and cuts checks, whereas Mr. Abhijit helps startups to get the funding. So with this, this is a unique combination, and then this is the right VC discussion that we are having it today. So let's start with the opening remarks from Manish and Abhijit on how the AI dilemma is going on and what is your take on it.
Hi, good evening, everybody. AI dilemma, whether it's exuberance, whether it's hype, or is there something real? I think it's a bit of both, bit of everything. We've been seeing these kind of scenarios much earlier. And every transformative technology cycle will always take a stage where valuations skyrocket and people feel it's a bubble, and eventually the end result of that, something true, something foundational comes out. So this happened in 90s during internet this happened in 2010 when iPhone came out. Even 2015, cloud became big. So at every point, there are situations where valuations skyrocket and people feel, okay, what's going to happen? But then the wreckage of that, we got Google, Amazon, eBay, iPhone. So many of these technologies come out only because the hype happens and a lot of people build, and there's a lot of trial and error goes into play, and then something of value comes out. In terms of, you mentioned that I think 50 odd % of the funding is going, which is highest I know of, because even in internet boom, it was around 40 odd %. So this is the highest concentration, but I think there are various reasons. I think we'll explore that as we move along. So short answer is a bit of both.
Okay.
Yeah, hi everyone. Good evening. First of all, thank you Ramesh for the intro, and thank you Eventex and Dr. Anoop and Riti for inviting for the event. So basically, to answer the question or like kind of the opening note what Ramesh has told, I think the answer is there in the remarks what he has made. He has told that like what 150 billion or 150 billion of funding has happened in AI, in which 52%, 52% of overall VC funding has happened in AI, but the number of companies have come down. So I think the hype is there for AI, but the investors are also looking for good companies. That is why the number of companies have come down, even though the investment amount has, I think from compared to last year, the investment amount might have gone up is what I believe. So the number of deals coming down is, which means that investors are focusing on good companies. And even in that 150 billion, I think 40 billion is by OpenAI or 13 billion is by Anthropic. So I think like kind of the investors are focusing on good companies. The hype is there, but again the investors are kind of monitoring all the AI. Like there are a lot of companies coming in. There are a lot of AI wrappers coming in. So the investors are focusing on good companies. They are betting on the best companies is what I feel.
Thank you. So just few half an hour ago or 1 hour ago, we discussed about AI for Bharat and how we build AI for India, AI firms for India. So Indian startups are not to the level of the Amazon or Anthropic billions dollars of funding. So how do you see the Indian investments, and how do you see the VC growing for India, where the number of deals could be high, but the value of the deals could be lower?
I think the numbers are slightly, gives a different picture, because most of the mega deals that have happened are into firms that are doing foundational models, and India, I don't think so, is in the race of that, at least not yet. And I think what works for India is more on the application AI segment, and for which we don't really need those billions coming in. We can manage with the millions that we get. One thing that remains still a core thing to move is finding real problems and solving those real problems, rather than just creating something, AI wrappers on top of ChatGPT and all that. So once that is there, I think in our circles there's enough. We are looking for those startups who are solving real problems, and I think we don't need to chase the billions, and when that is required, that will also come in, and it's all about giving values. Indian VC ecosystem is still new and it's yet to mature, so moonshot ideas were never given the preference, but I think that is also changing, and I think moving forward we'll see more funding coming in.
I like the idea. Solving the real problems is the key, rather than chasing the billions of dollars. I agree with you. And Mr. Abhijit, you have an impressive track record of structuring 50 plus fundraising deals. Assume that an investor comes to you, a startup comes to you and says that I'm an AI startup. So what kind of risks you see, what kind of red flags you see, and how do you take up that?
This is actually a real life scenario for me. Like a lot of companies these days come telling that they are into AI, but in most of the cases, I see this AI as a branding kind of thing. I mean, they are telling they may be doing something else, but they are telling that with the power of AI, by integrating AI into this, we are going to do this. So, one thing, using AI as a branding tool is a very big red flag, I would say. And on top of that, like using if your product is fully like kind of an AI wrapper from ChatGPT or Anthropic or whatever it is, again that's going to be like it's not going to sustain. Like it's not going to be a proper model. Then one thing what I've noted is like kind of not owning the proper IP. Like even though they might have built a product or something, but when we ask about the IP ownership and all, they are clueless. Like what to do, what we need to do, and all that. Those things are kind of I see as a red flag. These are specific to AI segment. Apart from that, like there are many other things which we can tell, but we'll discuss in the next questions or something.
So IP rights is the key, proper ownership of the thing and the real value, not just the wrappers.
And not just for branding purpose. Like just using AI as a branding tool doesn't work at least in the investment. This one.
Yeah, right. I think there was a saying, if the product doesn't have real value, you just put a beautiful girl next to the product and sell in the market. So the product will have value comes, sorry for the wording. Okay, so maybe there are companies they just add AI and come to the market, and I like your expression of looking at the real value and it's not the wrapper and the real usage. Thank you. And as an investor, how do you see this? What kind of risks or red flags you see when someone comes to you with AI startup?
I think again, as you said, AI for branding, putting AI up there in the pitch deck doesn't really help your cause. We would like to understand, by getting AI itself doesn't really make any decision for us. You have to again go back to basics and what problem you're solving and how AI is actually helping you solve the problem. I think that is one thing very clear. And in terms of if AI is helping you do that in a much better way, yes. How you're doing it, but if it's just an AI startup where your ChatGPT's next update is going to make you irrelevant, then that's not something we look at.
Thank you. And looking at the valuation side, how do you reconcile the traditional valuation metrics with AI startups valuation metrics? How do you balance these and arrive at the deal value?
Traditional valuations don't really work, the multiples thereof, right? Like if you look at a SaaS company will have won't really have cost on getting user, like once you have the thing set up, there's not really cost that associated with getting new user. Whereas in a AI startup, you have every API call, every inference from the model or any data refresh, everything, there's a cost associated to it. You're paying the model, and that brings down your margins to 20% or lower, at least in the initial phase, compared to SaaS companies doing 70-80% straight up, right? So there's no comparison to that. So after the initial basic financial check, we look at how good is your data proprietary or your model itself. Is there a defensible moat? There's so many other things around the model that we look at, and then come to a valuation. So we don't really use the old school multiples that we use for SaaS and other things. There's a different hybrid version that we use to get to a valuation.
Okay.
Yeah, so valuation itself is a like kind of controversial topic, I would say. Like a lot of because I see a lot of early stage founders coming to me and telling that they want to raise like 10 or 15 crore at 100 crore valuation, because they are seeing the PR or the newspaper articles stating that like Zepto might have raised $1 billion in 2 months time. So they are seeing all these articles, and that is something what people typically do. Uh, so see, the thing is like if you're a very early stage company, like be it an AI startup or anything, uh, it's not better to fix a valuation on your own. It's better you tell like what is your requirement, have a wording with the investor, tell them what percentage you are willing to negotiate. I mean, that is how the typical conversation happens. Then both of you agree at some point, and that is how values arrive. But coming to the practical side of doing evaluation, like if we were to do in a discounted cash flow method, that is the like kind of government accepted model. Even though, as an investor, he may disagree. Like DCF, anybody can alter. Like if you put the growth percentage from 5% to 6%, 100 crore value will go to 200 crore. Like that much of change you can make by just changing one number. But even though like while working on the DCF model, the main things what I've noted is like uh, the computed cost, like the GPU or the cloud costs are, there is a kind of volatility in those things. Then the secondary thing would be like there need to be a proper kind of bifurcation between what is going to be your research and development or the capital asset and what is going to be your operating expense. So that bifurcation mostly in case of startups or in case of companies, like they find it difficult. Like what should be the R&D, what should be because if you were to raise funds at a later point of time, like not at an early stage, a lot of thing depends on your EBITDA, a lot of thing depends on your revenue, all those things. So and when EBITDA is calculated, you will have to eliminate the R&D thing because that becomes an asset that goes to the balance sheet. So that is not part of the P&L. So that bifurcation, those things is actually a kind of bit challenging when it comes to the AI companies, is what I have felt.
Yeah, right. The traditional DCF models will not work, and we need to look at what the investor is looking at, and yeah, makes sense. Thank you. Maybe I have a scenario. Say a founder has an AI fintech startup. He has 10,000 paying users, and the revenue is $500,000, but he is burning $100,000 per month, which is like at the year end he is making $700,000 loss. And he got two term sheets, one from traditional VC, say at $8 million, and one from corporate VC at $12 million with restrictions. So how does the founder look at these two term sheets and what kind of call he should take it?
So $500,000 ARR
Yeah, right. Yes.
and 100,000 burn per month.
Yes.
Okay. So roughly around 20% burn. Okay. If you look at just plain valuation, 8 million versus 12 million. So generally, early founders, young founders will go for the 12 million one. But you got to understand how. So Mark Andreessen tells it the best. Like, don't go for valuation. Look at the terms. Terms is what matters. Terms is something you'll not focus early, but you'll pay for it much later. So we see standard, VC offer 8 million will be a standard terms, nothing, no restrictions, maybe around 5 to 10 years of exit is what they would be looking at, and maybe a board seat and maybe a few other drag along rights. I think that's all the VC is going to go for. Whereas a corporate VC, I think you got to look at what is in offer other than the money. If they're putting in restrictions, you may be up for acquisition in the next 3 to 5 years, and then the corporate VC can block it because it's part of the terms. So I think that's where you got to understand the terms, what comes with the money, what is the color of the money, and how well you're placed to take that money, and does it give you leverage or does you put you in shackles? I think that's what you got to understand and take the call. So I will go deep into the restrictions that are there and figure out if that is worth. If it's an eventual acquisition target, then maybe makes sense. Other than that, if somebody's going to put restrictions at the start of a relationship, I don't really advise anybody to go into that relationship?
Yeah. So same question.
Yeah.
Yeah. I mean, okay. My answer would also be more or less the same, because I've seen circumstances wherein founders have come to me with multiple term sheets from different investors. So we go through the terms. What all are the terms? I mean, valuation and dilution is obviously a factor. But more than that, even if you see the reality shows like Shark Tank or something, like, see, the investor makes a lot of difference. For example, if you are you are an edtech startup, and the investor has a lot of edtech companies in his portfolio, maybe like kind of even though that investor is offering a lower valuation, it's better to go with that investor, because he'll give you access to more other players in the edtech world, which can actually kind of help you with a lot of price negotiation. I mean, there is a company which I know personally. So they got funding from one VC which is backed by EdTech. So they connected them with all the national media heads. I mean, so their the price at which they were doing paper advertisement comparatively reduced, because they have got direct access to the heads of this department. Or if you are if you are a D2C company, and if you are speaking to an investor who has got a like kind of supply chain, like he has got deep rooted, like somebody like maybe like an Asian Paints, or somebody who has like kind of deep rooted network, maybe such a kind of investor would be fine. And also regarding the restrictions, like what all things, if at all the reserved matters, or like kind of the conditions that the investors are putting on you are very hard or very tough for you to survive, maybe like that also causes a issue, because at the end of the day you need to have that freedom, or like you need to have that freedom to follow your conviction or take that bold decision and all. But if at all those, like for 1 lakh you need to take approval from the investor, I mean, that is not going to work. So there are a lot of things depending on that. I mean, not just the valuation or dilution.
So, and many people attend this event are young entrepreneurs, startups, right? So from the legal and compliance perspective, what are the important aspects they should consider in the term sheet?
Okay, so one mainly like kind of what sort of instrument you are giving to the investor is the first thing. Typically, investors would be going for a CCPS or a CCD, preference share or a convertible preference share or a convertible debenture, because they need to have preference over the equity holders in case of a liquidation or something, which typically, I mean, happens in most of the startup deals. So what sort of instrument you are giving, what is the percentage, what is the percentage you are diluting. On top of that, you should be checking like what is the liquidation preference. Like when I say liquidation preference, for example, these are terms which founders often doesn't look. So for example, most of the VCs write a liquidation preference of 1x. But there are few cases where we see 1.5x or 2x being written. So which means that, for example, you run the the investor invested 1 crore into the company, okay, and you run the business. I mean, the business was profitable. Finally, at the end of the day, you have 1.5 crore in bank account, but for some reason, you are winding up the company. So at that point of time, the investor is having 10% of the company, the founder is having 90%. But if everybody were equity shareholders, this 1.5 crore should be distributed in the ratio of 90:10. The founder will get 1.35 crore, investor would be getting only 15 lakh, which is, I mean, not justified, because the investor has put in 1 crore as capital. But what happens with the liquidation preference is that the investor first gets his 1 crore back, and the remaining 50 lakhs is split in the ratio between 90:10. So what happens is the founder gets 45 lakhs, the investor gets another additional 5 lakh. But if the liquidation preference is 1.5x, even the investor has put in 1 crore, firstly you will have to pay 1.5 crore to the investor. The founder will be left with no money. So there are conditions like that. There are like, restrictive clauses for free transferability of shares for founders. There will be, for equity shares itself, there are vesting schedules. Even though the equity shares are owned by you, there are restrictions on transferability being held. If at all the founder leaves after 1 year or say 15 months, in that case, like kind of a portion of their equity gets forfeited. So there are clauses like that, which the founder is not much aware. They are in a hurry to kind of get the money into the bank. So there are lot of terms and conditions, which maybe like kind of the time won't be enough. Yeah.
It is a big term sheet, so every term needs to be read carefully and understand
Correct.
implications.
Yeah.
And also it needs to be read by somebody who understands it, because
Yes.
many a times a lot of people think they understand, but the language is such that you can be misled.
Yes. Yeah. And I like your point. Restrictive clauses maybe looks simple now, but pays more money at the end. Okay. And so, I like the clarification you have given on core dilemma. Some people argue AI is a bubble, and then some feel that this is the real growth that is happening. So, what is your suggestion to venture capital funds? Right? Is it a good time to invest in AI funding, or wait and see, or go aggressive in the market? What do you suggest?
I think it depends on a lot of factors: your thesis, your fund, which stage of fund you're in, early deployment or late deployment, how much you want to allocate and all that. But generally, what I would say is never to rush into anything. Don't go aggressively on anything, or don't sit out. If AI is part of your thesis, understand which part of AI you want to get into, what kind of technology you want to get into, where you want to invest, because sitting out will not help you unless you get into the water. You don't know where the fishes are moving, so you need to get your hands dirty. And most of the VC funds understand it's not every investment will give them a massive returns. It's just about getting enough exposure. And also, we are in the process of understanding this whole AI. We have just scratched the surface. Unless we understand, we keep investing and understand what is happening, and then eventually we'll be able to get exposure into much bigger things. I think basic business metrics has to be ticked. There's no point just throwing money around. It's going to spoil the market anyways. Go cautiously but optimistically, and cautious optimism is what I would go with.
Cautiousness and optimism, the right.
So I'll speak that from a startup point of view, like when to go for funding and when to not go for funding. So if at all your business is doing good, like you have found the early traction, your revenues are like kind of predictable or kind of stable, your churn rate is less. That's a good time you need to approach an investor if you need fund. Second, like the market conditions, if it is favoring your sector, like if you are into the AI sector, currently the market conditions are favoring the AI sector, but the investors are a bit cautious, I would say. So that's a good time. Then the third thing would be like kind of you have built a company, you have reached a stage wherein like kind of it's profitable, but beyond this, if you need to go, you need extra capital. Like you're doing good now, I'm good with this now, but if I need to scale, I need money. That would be an ideal time to approach an investor. And again, like kind of regarding the valuation thing also, like kind of if you get a good valuation now, again, valuation depends a lot on the market conditions as well. So if you look at the COVID era, like 2020, 2021, that is when most of the Indian companies got like kind of highest valuation. Even at some point, Byju's were valued at 22 billion. See, one of the main reason for that sort of valuation was a lot of fund was available. The US FedEx rates were comparatively low, so there were a lot of funds coming in from US. So that was one reason why companies got a lot of valuation. And for some reason, I have a feeling like in next 1 or 2 years, maybe something like that, because the investors are a bit cautious now. For almost like kind of few deals which I have worked on, the investors have liked the model, but they need to wait a bit more. Even with I've been pitching for a AI startup with 500k ARR now. They're doing like kind of 100 plus paid customers, pretty good. Like the founders have had 2 exits in the past. Still, the investors are giving good feedback, but they still want to wait for a little more traction. So there is like kind of people waiting to invest really. So I think like kind of so that is going to happen is what I think like in next 1 or 2 years. I mean, yeah, that's it from my end. Yeah.
And switching the gears slightly, so we also hearing that like 95% of the AI projects are becoming failures. So have you come across like any disasters in AI investment? Maybe 2, 3 examples or something if you can quote.
I mean, personally, I don't remember anything, but I believe like there will be a lot because, see, from a, I'm a chartered accountant. Like I'm one among the 2.5 or 3 lakh chartered accountants in India. Like the number of inquiries I get for startup funding or this with AI powered is too much. I mean, I hear the whole deck and I ask them like, where is AI? I mean, there would be nothing like. I mean, what you can do using ChatGPT. I mean, I'm not a techie. I'm not a tech guy, but I use ChatGPT a lot. I create my own GPTs for all the proposal creation, whichever duties can be automated, like for creating case studies or for creating, like when we reach out to investors, we create a no-name or document. For that, I have created a GPT. Like which all automation can be done that I am doing by myself, but I don't think that is a product per se. So one reason why the failure rate could be high is because of the 95%, a majority could not really be AI startups. They're just using the branding tag also. And like kind of what not like, I mean, ChatGPT is evolving. I mean, every AI is evolving. Now they have released the agentic version like what couple of months back. Now, so the agentic AI sector is also facing a issue. I mean, when we are pitching to the investors for an agentic model, they are also a bit concerned. I mean, they are waiting for how ChatGPT or Anthropic is going to, or Gemini is going to evolve with this agentic model, so that maybe at some point after 3 months or 6 months, the startup that is being pitched may become irrelevant because of the pace at which the AI is growing. So, I mean, personally, no such experience. I'm to tell the name, but over a period, I think like kind of will have the numbers coming in.
Disasters usually don't happen because of AI as such. General business failures, mismanagement of finances, vision, clarity not being there, understanding the market, understanding not being there. One thing you touched upon, a lot of people don't really follow what's happening with, let's say, ChatGPT or Anthropic or XAI. Like, what are they planning to do, right? And if you're doing exact same thing, you cannot outpace them at all. So again, don't build anything just because you want to build, just for the sake. AI is great, and I know something, and I'll build it. So always pick a real problem and iterate on solution, and that'll always be your, and have a defensibility moat, and you'll be safeguarded from many other disasters that'll come in. Also, gone are the days where a lot of people still live in 2021, where raise big, grow fast, and we'll look at profitability later. Now, most of the VCs, if not all, have gone into a phase where they look at unit economics very, very carefully, understand margins, look at your profitability. So you got to have profitability in mind to start with. Even if you're not profitable to start with, you need to have that mindset to start with. So that's what most of the investors are looking at.
So financial discipline is the key, can I say?
Absolutely, absolutely. And basic understanding of what's happening in the market.
And say founders, like if somebody is ready to invest, if VC comes to invest, so they get tempted and then they try to take the funding, right? Even if they don't need it. Is it a good idea to take the funding when it is available, or start focusing on building the fundamentals?
Building fundamentals always, and plus it's not that easy to get funding out of VCs. So generally, like I always joke around, we always have this joke running. A job of a VC is to say, out of 100, say no to 99 and run behind that one to take the money. So if it's available, if you're ready with the parameters he mentioned, yes, because you don't know what the market trend at that point would be if there's a funding winter or whatever. So if it's available and if you're ready to take the money, yes. If you're not ready, then don't really take the money. It's just, financial discipline. You have to build that in.
I think if they really need money, then effectively they should get the valuation and then approach people like Abhijit to get the help. And then
I mean, valuation is very much secondary or tertiary. I would say, like, primary thing is to have the basic financial discipline, the basic compliance in place. I mean, for your question, like, no VC would be coming without your fundamentals being proper. So, like, both won't come. Nobody would come to you. Then you build the fundamentals, won't happen. If your fundamentals are strong only, they may give you a term sheet, but in the due diligence phase, everything will kind of.
And how do you differentiate between noise and the real value of the startup? So I think you are talking to a lot of startups on a daily basis and cutting the checks. So how do you see this? Like 99 are noise, right? So how do you find out that one startup that deserves funding?
I think over a period of time, you kind of build that pattern recognition in you. It's based on experience. We make mistakes and we learn from them as well. So sometimes we are wrong, sometimes we are pleasantly surprised. So we try and go by a few models and few patterns, but we get surprised all the time.
The only thing is common is surprise.
Yeah.
Change. Okay. Thank you. One rapid fire question for both of you. Okay. One for you and one for Vijit. Okay. Name one thing founders should stop doing when positioning their AI startup to investors, and one thing they should start doing.
Stop making a headline saying I'm AI for this and I'm disrupting that. Because what happens, I mean, I'll tell you, like, it's when you're a category creator, you spend a lot of money educating the customers and people who are going to pay you. So investors always think that if you're a category creator, you should have that much more creds to do that. If not, it's going to fail. So unless you're really disrupting something, don't mention that. Your first slide shouldn't be something that will not you look further down, right? So that, please don't do it. And one thing to do, I think, show how exactly AI is involved in this, right? Show your margins, like how much you're spending, how much your margins are, how much, like in what way the AI is working, and in what few instances AI is not working, so that we know this is your strong suit, this is the weaknesses you need to cover. So give a sense of what exactly is happening. So I think these two.
Same question? Okay.
Yeah. For you, your favorite financial numbers. Okay. What is the one financial metric that's non-negotiable for AI startups seeking institutional funding, and one common misconception founders have about fundraising?
Okay. Maybe specific to AI startup, I would say what gross margin after computed cost, GMAC, like he was telling that earlier. So see, people typically, like SaaS companies have 70-80% gross margin. So the computer cost is actually, you should treat it as a direct cost itself. So the gross margin after computer GMAC should be one metrics. And if at all, like enough, you have a GMAC of 50% and you are able to sustain it at scale, I mean, that would be an interesting model for any investor, I would say. So GMAC would be one metrics which every AI startup should be monitoring. And what was the second question?
One common misconception founders have about fundraising.
Okay. Maybe like kind of giving a product demo to an investor, like giving a good product demo to an investor completes everything is a concept that the founders have. Because when I speak with founders, or like they tell that we have given the demo, it was good, the investors liked it. But on top of that, the governance and compliance and the financial discipline, that is also very important. Like you'll get a term sheet, but after the term sheet, there is due diligence. If you have to surpass the DD, like you should have the discipline, and it's actually very worse, like you having a term sheet and getting like kind of disqualified in the DD stage because you were expecting that funds to come in. You were maybe you might have built up some liabilities for that fund to meet. So I mean, it's a very disastrous state to be in. So just giving a good product demo doesn't mean that you have done good product. Just be compliant with your finance and compliances. Yeah.
Product is the starting point.
Yeah. Correct.
Okay. So you mentioned about GMAC, right? It's an interesting metric. Could you elaborate a bit for the audience?
Yeah. So basically, like kind of if you look at typical business, there is gross margin, we say. So gross margin is what? Sales minus direct expenses. I mean, including the COGS, cost of goods sold, if it's a trading business. So like in gross margin after computed cost means like kind of after sales, you deduct the direct expenses, what all are the direct expenses relevant to your business. And then you get the gross margin. After that, you deduct the computed cost. Like computed cost would be the GPU cost or the cloud cost or whatever cost you have incurred. So after that, you arrive at a second level gross margin after computer cost. So that is how GMAC is computed.
Thank you.
Yeah.
Maybe from audience side, any questions?
I want to understand what is your investment budget to total, I mean valuation of your investment firm.
Maybe like I don't have an investment firm like.
Sorry, I didn't get the question.
What is your investment firm present valuation of your company?
We don't have a valuation.
You are asking for the ticket size?
Yeah.
Ticket size.
We do $500,000. $500,000 is a check size.
There's something around 4 crores?
4 crores, yeah.
I mean, I don't invest personally. Like I mean, do like kind of fundraising and compliance. I'm a chartered accountant by profession. Yeah.
Thank you.
He helped the startups to build the financials, and then
After you meet me, you can meet him.
you can meet him. He cuts the check.
I think there was a question. I think there was a question there as well.
That's an interesting question.
Hi, my name is Deepthi. I'm the founder of an early stage startup that's a blend of consumer and AI. My question is, you mentioned a lot about GM, BCC and things that are more revenue driven or profit driven. So does that mean that you're not investing in early stage companies that probably don't have revenue figured out, but there is potential? Like, is that the trend that the entire market is going towards?
No, not at all. So what I mentioned was profitability mindset. So there are two kinds of founders. One who want to raise at any scale and grow at any scale with whatever losses and capture the bigger market. VCs are not really getting into that kind of businesses anymore. There are few who are doing it, but you need to have that kind of cred and that kind of like what Zepto is doing. But other than that, if you have the mindset, like eventually you're going to be profitable, and path to profitability, that's what we'd like to understand. We understand that you need to burn first, do a lot of things, and then get into the whole cycle. But then we'd like to understand how we're going to be profitable. That question can't be open-ended. At some point, I'll be profitable. So that is what we don't like hearing.
That makes sense. I have a follow-up question. Like, how do you? It's almost sometimes it becomes like a chicken and egg problem, right? Like your GPM would burn a lot of cash if you are, especially if it's consumer or more for a broader audience. So for that you need funds, but then if VCs are looking to invest a little bit later in the cycle, it's almost like you need to show growth, but then you need money to grow. So how do you suggest that founders look at that problem and solve for it?
High margins is one. You look at something with high margins. So that's the only way you can sustain yourself. Anything external you can't really rely on. You can get funding, you can do your friends and family or get debt funding to support yourself initially, bootstrap. And you don't know at one point you're going to get the money or you will not get the money. But the best money you can get is from the customer. If you can get money from the customer and can sustain yourself and build something like what our Kamath brothers have done, great. If not, there are people who will support you if you're doing the right things.
Thank you.
Thank you, sir. That was indeed a thought-provoking.
Thank you very much. Just to summarize, maybe I'll take only 1 minute. Okay. So it is clear that AI is not a hype. So AI is real. And then if you build your fundamentals of the company and if you build sustainability, then it's going to be, it can be a next Google also. So take it and go with positive note. And it's a great opportunity. Thank you, esteemed panelists, Mr. Manish and Mr. Abhijit. I personally learned a lot. It's an eye-opener for me. Thank you very much.
Thank you.
Last but not least, thank you, Mr. Anup, for creating this kind of venue and giving us the opportunity. Thank you so much.
Thank you too, sir, for organizing this. That was indeed a thought-provoking discussion. Exploring AI from both a risk-opportunity perspective, it's clear that while AI brings immense potential, smart investor decisions also still hinges understanding value and vision.
I would now request Mr. Anup sir to give away the memento to our respected moderators and panelists.